Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing HIMS and HERS stock so we can determine if it's a buy or a sell. This company may get into hot water with their name, him and her. Those aren't the proper pronouns. It should be they. They's health. Let's get started with the model. This is a small cap company, 1.5 billion market cap. They're trading at $7 a share and they have 209 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Negative free cash flow each year, but in the trailing 12 months it is positive. That's a big step. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's negative every single time period. Revenue is the sales for the company, and that grows a ton from 149 million to almost 300 million to over $500 million to the highest ever, over 700 million. We estimated 4 years of future free cash flows. We also estimated a terminal value. It's all cash flows past year 4, that's 3.3 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2.8 billion. We divide that by 209 million shares. And we get a calculated stock price of $14. They're trading at $7, so they're trading at a 49% discount. It's a really strong buy according to the model. The company expects really aggressive revenue growth in the next few years. If they can hit those targets, the stock does seem really undervalued. There are 29 companies in the same industry as HIMS, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend much in CapEx, only 14 million. These are investments in property, plant, and equipment. It looks like they're debt-free. They have a 0 debt-to-equity ratio. They just started generating free cash flow, so it's a small positive, worse than the median average. They rank 15th in market cap of the 29 companies, which is exactly in the middle. So their market cap is equal to the median. They are the median. They have a 4.7 price to book, worse than the median average. We can't look at their PE since they have negative earnings. They have a really high price to free cash flow because they have a small amount of free cash flow. They do have a good price of sales. It's between the median and average. This means investors are paying $2 for every dollar of revenue. Price of sales is market cap over revenue, or stock price over revenue per share. And we can't look at their 5-year annual revenue growth rate. They haven't been publicly traded that long. They released their second quarter results this week and they crushed earnings and beat revenue. The expected earnings was 3 cents per share. They reported 5 cents, so they beat it by 72%. Expected revenue of 205 million. They reported 208 million, so they beat it by 1.5%. So this is 4 straight quarters they beat their revenue forecast. Let's take a look at the company's second quarter presentation slides. One of the most important metrics when looking at this company or similar companies is subscribers. And that's up 74%. In the second quarter of 2022, they had 748,000. Now it's 1.3 million. Revenue growth is up even more, 83%, from 114 million to 208 million. They finally have positive adjusted EBITDA. It was negative 7% last year, and now it's positive 5%. That's their EBITDA margin, EBITDA over revenue. Their subscribers and revenue grow every single quarter. In Q3 2021, subscribers are 499,000, and 317,000 of those subscribers buy more than one product. 182,000 buy one product. And that goes up every single quarter. They broke through 1 million subs at the end of 2022. Now it's 1.3 million. Q3 2021 revenue of 74 million, 72 million online, 2 million wholesale. I've been using one of their products for about a year for hair growth. So you can see their revenue grows every single quarter, over 200 million in this current quarter. They had an EBITDA loss in Q3 2021 of 10 million. Their first positive was the fourth quarter of 2022, and it's still growing. It's 10.6 million this quarter. They expect next quarter to have revenue of 217 to 222 million, full year revenue of 830 to 850 million. Here's a picture of someone using the same product I use. One of their bigger sellers is erectile dysfunction pills. In 2025, they expect to have revenue of $1.2 billion, adjusted EBITDA of $100 million. They do have a net loss every single quarter, but they have their lowest net loss this quarter, $7.2 million. And to get adjusted EBITDA, you add back things like stock-based compensation, depreciation, amortization, interest, $2.2 million. That's the I in the EBITDA, and that's how you get to positive $10.6 million. Let's take a look at their 10Q for 6/30/2023. On the first page of the 10Q, it lists the securities issued. It looks like the only security they issued are their equity shares, their common shares, ticker HIMS. When a company issues preferred stock or debt, it's usually also on the first page. Let's take a look at their income statement. This is the second quarter of 2023, second quarter of 2022, first half of 2023, first half of 2022. Their revenue for the second quarter, $208 million. In the second quarter of 2022, $114 million. Let's see if we get a breakdown of the revenue so we know what it is. Of the $208 million of revenue, $201 million is online from people like me who buy their products through their website. $6.7 million is wholesale revenue, so they probably sell products to retail stores or online retailers. Online revenue went up 87%, wholesale went up 10%, so their total revenue is up 83%. So $208 million is 83% more than $114 million. For the first half of the year, their revenue is up 86%. It's $399 million compared to last year of $215 million. 1.3 million subscribers, up 74% from last year. Their monthly revenue per subscriber is $53. That's up 4% from last year. Below revenue is the cost of revenue. These are all the expenses directly related to generating the revenue, the expenses to make the products, also payroll expenses. That's $38 million. So they have a high gross profit, $170 million compared to $87 million last year. Their biggest expense by far is marketing, $107 million. This income statement gives us percentages. So let's look at this one. Their marketing is up 77% from last year, which helps their margins because their gross profit is up more. It's up 95%. Say, for example, their gross profit was up 60%. Then that means their margins will be going down because marketing grew more than gross profit. But that's not the case for this company. Operations and support, $29 million, that's up 68%. Technology, $12 million, up 72%. General and admin, $31 million, up 38%. So the total expenses, $179 million. Gross profit minus total expenses gives us a loss of $9.2 million. You really don't want to see a loss, but it is improving. Last year, they had a loss of $20 million. Once they break through $300 million of revenue, then they should have positive operating income. They did have a gain of $2.2 million from other income. Let's go back to their full income statement because their full income statement gives us shares outstanding. The bottom line of the income statement is their net income. They had a loss of $7.2 million, which is better than last year, a loss of $20 million. That gives them a loss per share of 3 cents. They have 208 million shares outstanding. Last year, 204 million. So they are diluting their shareholders. But as long as the company reports losses, they're probably going to need to dilute. Until they become profitable, then they can maybe buy back stock. Let's look at the balance sheet. Their current assets are $235 million. Current liabilities of $67 million. So their current ratio is about a 4. They can easily cover their current liabilities with their current assets. They have $193 million of cash or short-term investments. $21 million of inventory. They always need to keep a lot of inventory on hand so they can fulfill customer orders. $20 million of prepaid expenses. This is when they make an advance payment for a product or service they're going to receive in the future. It looks like they do lots of acquisitions. $111 million of goodwill. $20 million of intangibles. This could be patents, trademarks, customer relationships. Here's a breakdown of the intangibles. Most of it is trade names. $18.5 million. Total assets as of 6/30, $390 million. As of 12/31, $366 million. Let's look at their liabilities. Accounts payable is their largest liability, $38 million. That's how much they owe others for buying on credit. Accrued liabilities, $20 million. This means they incurred an expense they haven't paid yet, like a big bonus for an executive. Here's a breakdown of their accrued liabilities. $12.5 million of marketing, $4.5 million of payroll, $900,000 of professional services. Then you have taxes, product and shipping, and other. So their total liability is $70 million, last year $55 million. Let's look at their equity section. They raised $680 million from selling stock. They lost $362 million from running their business. So total equity, $320 million. It is up from last year of $312 million because they issued more stock. So you can see their additional paid-in capital went up about $26 million. Let's look at their statement of cash flows, first 6 months of 2023 versus the first 6 months of 2022. So they did have positive operating cash flow for the first half of the year. That's a really big step for a company, positive $26 million, compared to a loss of $26 million last year. And the way you calculate operating cash flow, you start with your net loss of $17 million. Then you add back the non-cash items on the income statement. Their biggest one is stock-based compensation, $31 million. This is when you pay employees with stock. They also had a positive $5.4 million of accounts payable. This means they bought items on credit. So it's like taking a loan. You receive products or services, but you don't pay for it. You pay for it in the future. When you actually pay for the items, then it'll be a cash outflow in a statement of cash flows. And then an inflow of $7 million from accrued liabilities. Let's look at the investing section. They spent $5.3 million on PP&E, property, plant, and equipment. In their financing section, they had a cash outflow of $7.4 million. Because when they issue stock or equity to their employees, they have to pay taxes on that. Let's look at the company on Simply Wall Street. Its last price was $681, 1.5 billion market cap, down 5% in the past week, up 14% in the past year. Let's learn a little more about the company. They operate as a telehealth platform that connects consumers to licensed healthcare professionals. They offer a range of health and wellness products and services available to purchase on its website or mobile app. They also offer prescription medication and ongoing care from healthcare providers, over-the-counter drug and device products, cosmetics, and supplement products, mainly focusing on wellness, sexual health, skin care, and hair care. The company created products including vitamin C, melatonin, biotin, as well as collagen protein supplements in the wellness category, moisturizer, serums, and face wash in the skincare category, condoms, climax delay sprays and wipes, vibrators, and lubricants in the sexual health and wellness category, shampoos, conditioners, scalp scrubs, and topical treatments such as minoxidil in the hair care category. They also offer medical consultation services as well as health and wellness products through wholesale partners. They're based in San Francisco, California. They were acquired by a SPAC, a special purpose acquisition company. All SPACs start at $10. So usually the stock starts going up when the company announces the acquisition. Its peak was in February 2021 at $24.46. Its low point was in May 2022, $3.47. It did get up to $12 in May 2023, but it has come back down. It's sitting a little under $7 currently. Simply Wall Street's price target is $24. They say the stock is 72% undervalued. There are 10 analysts pricing this stock and their price target is $13, so they also say the stock is pretty undervalued. Look how much their revenue has gone up since 2018. It was $27 million. At the end of 2019, $83 million. Pretty big jump. At the end of 2020, $149 million. For all of 2021, $272 million. Almost doubling to $527 million for all of 2022. And their trailing 12-month revenue as of mid-2023 is $711 million. The revenue forecast for 2023 is $847 million. For 2024, $1.05 billion. And for 2025, $1.28 billion. So this could be a really good time to get in on the stock. It looks like they had some debt in 2018, $8 million. When they went public, they did receive a good amount of cash, so they paid off the debt. And for the past 3 years, they're debt-free. And the equity has gone up quite a bit. It was only $23 million in 2018. It peaked at $355 million in September 2021. It's currently at $320 million. And this green line here is their cash. They always have lots of cash. Their highest cash balance was $323 million. That was in March 2021. They currently have $193 million. The CEO's salary is $600,000, total compensation $10.8 million. His tenure as CEO is 6.6 years. In the past 12 months, there's been no insider buying, just selling. Lots of sells, some really big ones. Almost 3 million shares have been sold in the past year. 60% of the companies held by institutions, 18% by the general public, 15% by insiders, and 7% by VC and private equity firms. The CEO is the biggest shareholder at 9.5%. Vanguard is at 6.5%. Goldman owns 0.7% of the company. Their employee count has risen a lot over the years. They had 131 employees in mid-2020. They're currently at 651. And the ticker trades in only two places, the New York Stock Exchange and the Deutsche Börse. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.